team, let's cut right through the noise. Goldman Sachs just dropped their Q1 numbers. And yeah, the headlines are absolutely screaming victory. But you know us here at Iron Financial. We don't just read headlines. We grab our tools, we go down to the site, and we inspect the foundation. We're here to help you forge a stronger portfolio, and that means we have to stress test the absolute titans of Wall Street. So let's get right to work.
Okay, so let's frame this whole thing up. The big question, the one we're going to spend this whole explainer answering, is really simple when you boil it down. Is this massive earnings beat we're seeing a sign of a true fortress of profit? You know, an unshakable pillar holding up the market? Or are there cracks hidden just beneath the surface? Weaknesses that could turn this whole thing into a house of cards the minute the next real storm hits? That's what we're here to find out. We are going to put the bull case right up against the bear case and see which one is actually built on solid ground.
So, let's start with the bull case. And I'll be honest, on the surface, this thing is an absolute show of force. The top-line numbers, they aren't just good. They're a statement. This is Goldman standing up and telling the entire market that they are firing on all cylinders and that anybody who doubted them was just dead wrong. You know, the market was hungry for a sign of strength, and Goldman, they delivered a knockout punch right out of the gate.
First up, the headline number that everyone's talking about, earnings per share. They posted a GAAP profit, and for those of you keeping score at home, that's the official rulebook, generally accepted accounting principles. A profit of $17.55 per share. Now just look at that number for a second. The Street, the analysts, they were expecting $16.47. Goldman didn't just step over the bar, they launched over it by a full $1.08. That's a 7.1% beat. Let me tell you, in this game, that is not a rounding error. That is a power move. It's a clear signal of elite performance, designed to make every rival and every short seller sit up and take notice.
Okay, now let's move over to revenue and see how this story builds. Total net revenue. It came in at a staggering $17.23 billion. This also just crushed what the analysts were predicting, which was hovering just a hair under $17 billion. But here's the really important part. This represents a powerful 14.4% surge compared to the exact same quarter last year. In a complex market environment like this, with all the talk about lingering inflation and geopolitical chaos, for a titan like Goldman to lock in double-digit year-over-year growth, well, that's a massive signal of fundamental strength and just pure aggressive market leadership.
And this slide right here brilliantly illustrates the efficiency of the whole machine. An annualized return on equity of 19.8%. Now, the Street was hoping for maybe 18.7%. This number, the ROE, tells you exactly how effectively Goldman is using its shareholders' money to generate profits. For a small, nimble firm, maybe 20% is achievable. But for a global behemoth like Goldman Sachs, anything approaching 20% is absolutely exceptional. It proves they're not just big, they're smart, they're lean, and they are a highly profitable machine at work.
Whoa. Hold on a second there, analyst. You've laid out some seriously impressive headline numbers, I'll give you that. A fortress indeed. But you and I both know a fortress is only as strong as its individual walls. Before we go declaring victory, let's actually go down into the engine room and break down where this record revenue is truly coming from. Are all the engines firing on all cylinders? Or is one supercharged engine doing all the heavy lifting while another one is starting to sputter? Let's inspect the components before we get carried away by these big, shiny numbers.
I'm glad you asked, Skeptic. Let's go right into that engine room. Look at this table. We can start with the whole division, global banking and markets. A solid beat right off the bat. But let's drill down even further. Check out equities, sales, and trading. They brought in $5.33 billion when the Street was only expecting $4.9. That's a massive beat. They're just dominating the market there. Now look down a couple rows to advisory. They absolutely crushed the estimate, bringing in $1.49 billion. This is huge because it signals a major comeback in the mergers and acquisitions space, and it shows Goldman is leading the charge, just gobbling up market share. So you see, this isn't just one engine firing. It's a synchronized display of power across their most important core businesses.
And just to hammer this point home, look at the trend on this chart. It's so clear. The bar on the left, that's the revenue from Q1 of last year. The bar on the right, that's this quarter. That leap you see, that 14.4% year-over-year growth, that is not a fluke. It's not a one-off. It's a clear upward trajectory, right there in plain sight. It tells us the engine is actually gathering steam, not losing it, which is exactly the kind of thing long-term investors want to see. This, my friend, is the definition of accelerating momentum.
And hey, don't just take my word for it. As the summary from TradingView puts it, and I quote, "Record GBM revenues and strong asset inflows drove robust earnings and capital returns." The key takeaway here is that the core global banking and markets division, the very heart of the entire firm, is performing at a record-breaking level. This is the solid concrete foundation of the whole bull case. It's not just one metric, it's the entire core business hitting it out of the park.
And finally, let's talk about real, tangible, durable value. Tangible book value per share, or TBVPS as we call it. Now this is a critical metric because it strips out all the fuzzy stuff like goodwill and intangible assets and tells you what the real, hard net worth of the bank would be if it were liquidated tomorrow. Well, it grew 13.4% year over year to $361.19. That's a 5.7% beat over estimates. This isn't just paper profit, folks. This is Goldman physically building a stronger, more valuable foundation for its shareholders quarter after quarter. This is how real, long-term wealth is actually compounded.
All right, analyst. You've built a very, very strong case for the fortress. I'll admit it. The numbers are undeniable, and that bull argument is pretty compelling. But, as you know, here at Iron Financial, we know that even the strongest fortress needs a thorough, painstaking inspection. Every structure, no matter how solid it looks, has potential weak points, stress fractures that only really appear when you put them under pressure. It's my job to find those cracks. So let's take out the magnifying glass and really stress test this foundation you seem so confident about. Okay, let's go right back to that engine room you were so proud of a minute ago. You celebrated the wins, and they were impressive, but you conveniently skimmed right over the big miss, right? Fixed income, currencies, and commodities, or FICC, revenue came in at just $4.01 billion. Any idea what the estimate was? $4.87 billion. That is not a small miss. That is an $816 million hole in their trading revenue. In a quarter this strong, a miss of that magnitude in a core division that's supposed to thrive on volatility, well, that's a massive red flag. Is this the first major crack in the armor? I think it might be.
And this slide right here really puts that recent growth into some much-needed perspective. You're celebrating this big acceleration, but let's zoom out for a second. The 5-year compounded annual growth rate for revenue is, well, it's a pretty sluggish 2.5%. Now, the 2-year rate is much better, I'll grant you, at 11.9%. So the real question becomes, is this new burst of speed a sustainable new trend, or is it just a temporary sugar rush from a hot market that could fade just as quickly as it appeared? The long-term picture suggests this high-octane growth might not have the fuel to last. We could very easily see it revert right back to that slower, more pedestrian pace.
And believe me, the concerns do not stop there. Let's talk about costs. Total operating expenses grew 14% year over year to $10.43 billion. That's almost perfectly in line with the revenue growth, which means their margins aren't expanding at all. What's worse is that their headcount, the number of employees, remained essentially unchanged from the end of 2025. So their costs are rising without them even adding people to the payroll. Where is that money going? On top of that, the provision for credit losses, that's the money they set aside for loans that might go bad, it increased by nearly 10% to $315 million. They're clearly expecting more pain ahead. And finally, the standardized CET1 ratio, that's a bank's core capital buffer against its riskiest assets, it came in at 12.5%, well below the estimated 14.1%. So let's add it up. Rising costs, higher credit provisions, and a weaker capital ratio. These aren't just little cracks. These look like potential stress fractures forming deep, deep under the surface.
Okay, those are all valid points, Skeptic. You've identified the risks, and they absolutely need to be addressed. To figure out if this growth is actually sustainable or if those cracks you just found are going to spread, we need to look at the environment they're operating in. And what better way to do that than by looking at Goldman's own global forecast for 2026? This is literally their map for the year ahead. Let's see if the landscape supports my fortress or your stress fractures.
All right, let's break down their blueprint for the world. They're forecasting global GDP growth at 2.8%, which is actually sturdier than the consensus of 2.5%. They see the U.S. outperforming even that, coming in hot at 2.6%. They're projecting the S&P 500 to rally another 12%, and they see China's economy growing at a solid 4.8%. The only real note of caution is for the euro area, which they say faces a cyclical boost but a structural drag. So all in all, it's a generally very positive outlook. A strong U.S. economy and a rallying stock market that provides a very solid foundation and a pretty significant tailwind for pretty much every single one of Goldman's businesses. This map seems to point directly towards continued strength.
But hold on, let's look a little closer at that S&P forecast. Their own analysts describe it as a broadening bull market, but, and this is key, with lower index returns than in 2025. Now, what does broadening actually mean? It means the rally is expanding beyond just a handful of mega-cap tech stocks. Well, that can increase volatility. And lower returns implies that the easy money has already been made. So, Could this more complex, more volatile market be exactly the kind of environment that challenges their trading revenues? This could be the explanation for that big FICC miss we just talked about. It might be a preview of a much tougher road ahead, even within what is still an overall bull market.
All right, we've laid out all the evidence. We have the incredible show of force from those headline numbers, and we've put that up against the pretty significant cracks we found under the surface, the FICC miss, the rising costs, that weaker capital ratio. So it's time to weigh it all. Here at Iron Financial, this is what it all comes down to. We've inspected the fortress, we've stress-tested the foundation. It is time for the final verdict. Is Goldman Sachs in 2026 an opportunity, or is it a trap?
Let's put everything on the scales, right here, right now. On the bull side, you've got a massive EPS and revenue beat. You've got record-breaking revenue from global banking and markets, an incredibly strong 19.8% return on equity, and powerful 13.4% growth in tangible book value. And we see clear, undeniable dominance in the resurgent advisory and M&A space, all backed up by a positive macro outlook from the firm itself. This is the fortress. But on the bear side, you simply cannot ignore that significant FICC trading miss, a nearly billion-dollar hole. You have a 14% rise in operating expenses that's eating into those gains. You have a sluggish long-term growth trend that calls into question the sustainability of this whole recent surge. And you have increased provisions for credit losses and a weaker-than-expected CET1 capital ratio. These are the cracks. So, analyst, the big question is, can the fortress withstand the pressure on these cracks?
So here's the crucial point. Our final synthesis is this. The foundation is undeniably solid. The earnings power, the core business strength, the shareholder value creation, it's all top tier. You cannot look at this report and call Goldman Sachs weak. It's just not true. But at the same time, you cannot ignore the risks. The FICC miss and the expense growth are real. They are not hypothetical problems down the road. They're happening now. So what does this mean? It means that while Goldman is an incredibly powerful player, it is not a risk-free investment in this market. The cracks are real, and this demands disciplined risk management, both from the company and from any investor looking to take a position. And that brings us to the final, critical question we want to leave with you today. For decades, Goldman Sachs has been a pillar of the financial markets, a true bellwether. The question for all of us now is that pillar as strong as it has ever been, ready to support the market's next leg up, or are the cracks we've identified today, that FICC miss, the rising costs, the capital concerns, are they the very first signs of stress fractures starting to form in that pillar? That's the analysis you need to continue. Thank you for joining us here at Iron Financial. Do your own research, always manage your risk, and go forge a stronger portfolio. We'll see you next time.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.